person's future. Thus, often influence investors when approaching their investment decisions. The first being herding bias. This is the tendency for investors to mimic the investment decisions of others instead of making their own independent decision based on their own analysis. So an example of this would be, let's say I choose to invest in some Amazon stock. I go to my Randall Research class and I share with them that I have chosen to do so. Maybe some of them also choose to buy some Amazon shares. They go share that with some of their other friends and family, and the effect continues and eventually a herd is formed. And then there's also status quo bias. This is the tendency for investors to maintain their current state of affairs with their investment portfolio solely due to the duration of time that has passed. So using the same example, let's fast forward 20 years from now, and let's say I'm still a holder of my Amazon shares solely due to that duration of time that has passed. So delving a bit deeper into herding bias, what causes this to occur? While information asymmetry may be present, this is when some investors have access to more information or have done more in-depth analysis on a certain stock or group of stocks, leading other investors to have this tendency to mimic their investment decisions solely due to that information. Fear and panic might also be present, where some investors have this sense of fear that if they don't follow the herd, they will miss out on a large upside opportunity. And that also feeds into regret aversion, where investors have this sense of fear that they will regret not following the herd in the future. So why is herding bias so important? Well, it affects the informational efficiency of market prices. So in other words, the stock price of a certain security might not accurately reflect the true intrinsic value of that company. And eventually, that true intrinsic value will be realized through a market crash following a market bubble. And this can, of course, have potential significant effects on economic outcomes and leads the market not to be efficient. And then with status quo bias, it's very similar in the sense that investors can be irrational, holding on to underperforming investments and being hesitant to rebalance their portfolios to some other security that might benefit them more in terms of upside in the future. So similar to herding, status quo can have significant economic repercussions. So when conducting the literature review process in our research, it was evident that although both of these biases had been investigated thoroughly and independently, the comparison of the two had not yet been explored, which led us to the unique question of, does a herd overcome status quo bias? In other words, if we put both of these biases together in a laboratory experiment, which bias would have a stronger pull on investors? So to test this question, our experimental design will have 30 rounds, and participants will be divided into 3 investor types: Investor A, B, and C. Investor A will be endowed with 100 Tide Lab dollars and 1 unit of asset A. Investor B will receive the same but 1 unit of asset B, and Investor C will be endowed with 150 Tide Lab dollars and no asset. So investors A and B will be classified in groups SQ, standing for status quo, as they are given an asset. So then later on they will be given the choice to either stick with their asset or invest in a new asset, so that status quo is being induced in them. Whereas with investor C, they are given no assets, so they're in group NSQ, as no status quo is being induced. And then in a series of 30 rounds, these investors will receive the option to either invest in asset A or B. And in the first round, each asset will have a 50% chance of being a good asset, which is associated with an addition of 100 Tide Lab dollars, and then a 50% chance of being a bad asset, which is associated with 0 Tide Lab dollars. So overall, in the first round, there are 4 possible outcomes. Number 1, both assets are good. Number 2, asset A is good and asset B is bad, and then vice versa. And then finally, both assets being bad, each with a 25% chance of occurring. So before these investors make their decisions, they will receive a tip about each asset from 2 urns, urn A and urn B, urn A corresponding to asset A and urn B with asset B. and each on will have 10 colored balls. If it's a good asset, the on will have 7 green balls and 3 blue balls. And if it's a bad asset, the on will have 7 blue balls and 3 green balls. So the system will randomly select a ball from each on and reveal this to the investors. So for example, if an investor gets a green ball from on A, this will lead them to most likely think that asset A is a good asset, as the chances of getting a green ball showing that it's a good asset is higher. All investors will also be randomly assigned a number, 1, 2, or 3, and the number will be unique within a group. And this number represents their turn in terms of choosing their asset. So investor 1 will go first, then 2, then 3. And this is how we are inducing the herding bias, because investor 2 will learn what investor 1 does, and investor 3 will learn what investor 1 and 2 does. So through this, a herd most likely will be formed. And then to wrap up the procedure, the first step will include investors A, B, and C being randomly assigned to numbers 1, 2, and 3, again representing their turn in terms of choosing. Then investor 1 will receive that tip from the on and make their investment decision. Investor 2 will receive their tip and learn the decision of 1, make their decision, and then investor 3 will receive their tip and learn the decisions of 1 and 2 and make their decision. And it's important to note that each investor will have their designated number for a total of 10 rounds, so it'll be randomly assigned to ensure that it's evenly distributed amongst the investor numbers. And so we'll be inducing that status quo initially, then introducing that herding bias and seeing which one has a stronger pull. And in terms of next steps for this experiment, we will be conducting this experiment in the TIDE Lab, which is the Interaction Decision Experiment Laboratory in the Culverhouse College of Business, where we will invite Culverhouse College of Business students to come and participate in our experiment, and we'll actually be able to incentivize them with real money based on how good their assets perform. Yeah, these are my references, and I'm happy to answer any questions.
I was wondering if there's any kind of like personality or inventory profile you could do of the investors before they participate, because it could be that certain investors have a level of greediness or fear, so that could bias like the response. So is there anything on the front end you could do to like understand better what the investors are thinking?
Yes, so we're actually doing a risk assessment of the investors. However, we're doing it after they conclude with the experiment. So they'll make all of their decisions, and then we'll be giving them a risk assessment. We'll be telling them to choose between 2 assets, each with a 50% chance of it being good or bad, and then they can choose how much money that they want to invest. So of course, if they choose to invest a large amount of money, then most likely their risk profile is a lot larger. So that'll help us determine their personality traits in terms of riskiness of assets. And then we also most likely will do a little questionnaire asking about their background, just to use it for further analysis.
Can you talk about the importance of the tips and how it applies to the real world?
Yes, so the main reason why we are incorporating the tips is when investors in the real world make decisions, of course, they're not basing their decisions on just randomness. They often have access to a lot of information that helps them make their decisions. So for example, if a company just reported their earnings and they did really well in a past quarter, this is a good indicator that in the next quarter they'll also do well and might lead investors to buy that stock. So it kind of allows these investors to have something to base their decisions off of. And of course, in the real world, nothing is ever certain. So it kind of is a good replication of that uncertainty, but still kind of an indication of the future.
How is your research contributing to more efficient financial markets?
Yes, so I kind of mentioned it in the beginning, but when investors are engaging in these psychological biases, it often is due to them being irrational. And irrational behavior are these deviations away from standard economic theory. It's not things that we can necessarily predict. So it's important to have a better understanding of these irrational behaviors for the future, as it can lead to inefficient markets. It can lead to surprises in the stock market. So the more data we have on these psychological biases, such as herding and status quo, will benefit the efficiency of markets in the future.
So you said you were doing 10 rounds of this experiment, I believe. So can you speak to how applicable this research would be to a larger population?
Yeah, so we're actually going to be doing 30 rounds, and each investor will be investor 1, 2, and 3 for 10 rounds. So we have evenly distributed data. And this is 30 rounds for one experiment, and we'll probably start with that much data, and then we will most likely kind of go from there. If we need to do more tied lab sessions, we will do so, and we'll go from there in terms of applying it to a larger audience.